Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. The big question in the minds of almost everybody currently is, with the second wave of cases and sadly even mortality in India, will there be a disconnect between what's happening globally versus what's happening in India to the markets? Yes, I know that the whole of last year, the market shrugged off the COVID blues, but all of us would do well to remember the initial period that came about when the markets had a big pullback. And currently, it will be safe to assume that we are nowhere near the close, or safe to know that we are nowhere near the lows of the markets, and therefore it raises the worries even slightly more. Let's get in somebody who can analyze both the local and the global picture with equal gusto and try and marry the two to tell us what is his sense of how investors at large would approach the world markets in India within that currently. Bharat Iyer joins in. Needs no introduction, really. Bharat, so good having you. Thanks for joining in. I hope all is well. So Bharat, that's really the key question. Let's focus on the world markets for a bit and then try and juxtapose India within that picture. US seems to be doing all the right things currently. And what do you make of their vaccination drive, the economic data that has come out from there, including the jobs report that came out just last week? And what does all of that mean for the US markets?
Well, Neeraj, I think it's absolutely a Goldilocks kind of syndrome as far as the US markets are concerned. I think the vaccination drive there is going very well. The last data I saw, they have crossed about 43% in terms of active vaccinations done. So I think they're making very good progress as far as the vaccinations are concerned. On the other hand, if you look at the economy, I think it's doing very well. Primarily it's being driven by housing and the manufacturing sector at this point in time. But by and large, economic data that's coming out seems to be surprising on the positive side. And I think you have another engine waiting to fire, which is the services sector, because you expect that once the vaccination drive reaches a particular critical mass, a particular threshold, the services sector is also going to start picking up. So you also see another driver of growth waiting to happen. And all this with inflation remaining relatively well behaved. So I think they're absolutely in the sweet spot, and which is the reason the markets are reflecting both the current positivity as well as expectations that the future should be.
So Bharat, well, my question is just that, right? They had the benefit of being able to give out a large amount of stimulus, and within the other major markets across the world, there is one problem or the other. Eurozone has some issues. China has the discounting factor of most nations viewing it with distrust, even though their own pullback from the stimulus has led to a pullback in the Chinese markets. And India, while not a major market on the world scene in that sense, but since we are attached to it, is seeing fresh cases. So therefore, to your mind, does it mean that a large number of global investors will probably wonder what's the need of drifting away from the mother market currently when everybody else has a problem and the mother market does not?
Well, yes, I guess we'll have to segregate the near term from the medium to long term. I guess if you look at the market narrative, what has happened in the last 12 months is initially you saw central banks in particular pumping in across the world, pumping in a lot of stimulus, and that rising tide lifted all boats. Now what you're seeing really is markets are getting a little more discerning for two reasons. The first reason is, I guess, I think markets are recognizing that, look, the best of the stimulus bit is over. And, you're actually beginning to see monetary stimulus peak, i.e. also beginning to fade a little bit. And we can talk about it later if, it's a topic of interest to you. So, that's one thing which is happening, which really means that, valuations have likely peaked and, this general trend of all markets doing well is over. So now markets are getting more discerning. And what they're really focusing on is, which are the countries where, growth is, meeting expectations or beating expectations, and which are those countries which are, either growth is not meeting expectations or, is running below expectations for any number of reasons. Could be a second wave, could be anything else. And you're beginning to see a dispersion in terms of returns and a dispersion in terms of market performance. And I guess we are going through that phase. And what it really means is that markets which tend to meet expectations or beat expectations will continue to stay well bid. Whereas if you don't meet expectations or you have a second wave, etc., then in the interim you're going to underperform.
Okay, just wondering, Bharat, there is also conversation in international media about whether the US economy is overheating in the first place. There is also this. I mean, forget the last 3 days, but until before that, there's this whole fear of inflation and rising yields putting some problem or becoming some problems for the US markets as well. What with the fact that enough and more data which sliced in a particular fashion will show that the US markets are so much more expensive compared to historical standards. So on a relative basis, US economy and markets may be doing very well. On an absolute basis, do you reckon, in your assessment, that there is some danger lurking around the corner, or would you believe that the economic uptick will take care of the fears around the markets as well, US in particular?
See, it is the way to look at it is, as you rightly mentioned, we've seen yields spike up very meaningfully. Now, yields can spike up for two reasons. They can spike up because, the growth is doing very well and confidence on growth is improving, or there is a huge inflation problem developing. So far, I guess, the good part is that, yields have gone up largely because, growth data has surprised on the positive side. And as I said, there are other levers to look forward to over the future as well. As you mentioned, the fiscal stimulus is still to play out. Services have yet to join the party, etc. So, a large part of the pickup in yields has really got to do with, the pickup in growth and the confidence on growth over the future. We haven't seen any ugly data as far as inflation is concerned. So, as long as this construct continues, you don't really see any major danger to the market. And, the markets could stay well supported. But yes, as both of us know very well, inflation is typically the party pooper for markets on a cyclical basis. And one has to be very wary of inflation because if, yields start going up, not because of, better anchored growth expectations, but because inflation is rearing its heads, then I guess, one would have to be concerned. So, I would stay positive in the US markets, but, yes, definitely you have a valid concern. Watch out for inflation. If that data starts getting dirty, which it's not getting so far, then there's reason to start unwinding the positive stance.
Okay, and one more question, Bharat. Would you believe that investors or short-term investors or traders the world over, if for the near term, would look at the vaccination data and how countries are vaccinating their populace and give that more weightage as opposed to some of the other factors? Because I see a lot of reports which are constantly referring to how soon would nations vaccinate, and therefore imbibed, I presume, by that study is that the belief is that if the vaccination is done quickly, then the economy gets back on track quickly, so on and so forth. Would that be a telling factor, or you reckon that it's a talking point but not a major one?
No, it is a meaningful data point. So I think, investors will, as I said, what happened was with that rush of liquidity that came last year, obviously growth expectations, were very, very well anchored. And there were very positive estimates out there, be it for economic growth or be it for earnings growth, albeit of a low pace. And, what investors now will look at definitely is, in terms of, the vulnerability to a second wave or a third wave as the case may be, and also vaccinations. Because the good part is, you have a vaccine. So you know that, this problem is not something that's going to continue into the future and we don't have a time frame for it. It's not a 3-year or 5-year problem. You have a vaccine. So, as long as you get a bulk of your population vaccinated, it really means that, the problem is going to be contained within a particular time frame. So investors will pay due attention to both the number of cases coming up in the second wave or the third wave, as well as the vaccination data and what percentage of the population is now safe.
Okay. So what's your sense, Bharat, of how do you juxtapose EMs in the current landscape? Again, what is true for India, could it be true for EMs, the generally more risky in asset class in perception? And if the DXY, if the vaccination, if the economic factors, all of them are pointing northwards for the US, would EMs as a basket suffer in the near term? And would that be a factor of flows as well as the currency?
See, here's the way I look at it. I think the markets are going to be, and investors are going to be a little more discerning, and it's not going to be a very easy DM versus EM comparison. I guess because what's going to happen is even within DM, you probably see that, the vaccination data in the US is much better. The growth data picking up in the US is much better. The stimulus seems to be working much better in the US. Whereas if you see Europe, it's mixed. Be it the success on the vaccination front, or be it the data coming out there, or be it the success of the stimulus. So, is there a reason for the US to, outperform Europe? Yes, there is. Likewise, I think what's going to happen even within EM is, some markets are going to have more success in terms of the vaccination drive initially. Yes, eventually all of us will get there. But, initially some markets will, have more success. Or, the index of economic surprises on the positive side will be better for some markets and worse for some markets. And, I guess that will get reflected in relative market performance. And, you're already seeing that even in the policy construct, isn't it? I mean, you'll be surprised to note that, 3 EMs have actually raised interest rates in the last 3 months. And that tells you that some EMs are now very confident or are very comfortable with the growth construct that they have, whereas some are warning of pulling back stimulus, and some are saying we still need to keep the stimulus very much alive because we are not out of the woods. So I guess it's going to be a very country by country call rather than a broad EM versus TM call. That said, yes, I guess the point you made about the dollar is definitely going to stay well supported on a cyclical basis in this kind of construct. And so, investors are going to factor in currency considerations when they make a business.
Anyway, speaking of all of those points, Bharat, we have a very important policy. Every RBI policy in the last 6 months has seemed to be the most important policy in the recent past, and this one might not be any different. Do you expect a bit of a dovish stance considering how cases have spiked up in the country? Part one of my question is that. Part two, RBI has done the heavy lifting thus far. By virtue of all the reserves and all the other factors that RBI has in its arsenal, do you reckon it has the ammo to be able to do more heavy lifting should that be required?
See, Niraj, I think to be fair to the RBI, they've done a stellar job in terms of anchoring the economy and anchoring expectations through what has been a very difficult patch over the last 9-10 months. I think to be fair to them, they have communicated even in the last policy that they will prefer to err on the side of caution and remain accommodative for longer than is required rather than derail the growth process in any way. So yes, I mean, I don't know if dovish is the right expression, but I think they will remain accommodative for as long as it requires. And as you rightly pointed out, given the recent spike in cases, there's all the more reason for them to stay as accommodative as they can for the foreseeable future. So I don't see any change in stance. They've done a very good job and they continue to do a good job. And we have to remember that they're working under meaningful constraints, particularly given that the government's borrowing program for fiscal 22 is going to be meaningfully higher than it was last year. So I guess they have that challenge as well. And yeah, good luck to them.
Yeah. Now, Bharat, where does that place India with all the things that are happening around the world? And the fact that we have a second wave, we are firmly in the midst of one, but we are also vaccinating the population. At times I find it a bit interesting to note that we are probably the vaccine manufacturer of the world, so to say, and yet the vaccination drive is not really taken off with gusto, so to say. So where does that leave us? Also considering the fact that in all probability, the current valuations that the market has prices in a full-blown earnings recovery, and at the start itself, we have a bit of a stumbling block in that Maharashtra has done what it has done. So how does India fit in, and Indian markets kind of fit in the jigsaw puzzle?
See, Niraj, I think, if I were a global investor or an emerging market investor, I mean, if I were to take a medium to long-term view, India would slam dunk be an overweight for me. Because, India has two big advantages. I mean, we obviously, which we have talked about ad nauseum. One is, we have a great demographic advantage, and which is only going to keep getting stronger for the next 15-20 years. And we also have the ability to absorb a lot of capital. And let's face it, we are living in a world where there is a lot of capital, and we offer very attractive yields. So on a medium to long-term basis, I would still expect investors to have an overweight bent of mind or an overweight stance towards India. That said, near term, and the other positive also is at the raising, answering the other aspect that you raised in terms of vaccination. Yes, I think all of us would like the vaccination drive to gather momentum, and we'd like to see the pace improve. But that said, the good part is there is a vaccine out there, which means the time frame for this whole problem is not unknown. It's not indefinite. We know that, okay, we may not do it all in 3 months, but we'll definitely do it in 6 months or a year. So this whole problem is a limited tenure problem. It is not a problem which has an indefinite tenure at this point in time. So that's the positive I'd look at. That said, I agree with you. Near term, if I look at it, we're trading at about 23 times forward earnings. I don't have a huge issue with valuations per se, given where we are in the economic cycle and the kind of liquidity that is around. But that said, I think the other point that you made is very valid. I mean, earnings growth expectations are very meaningful. I think, over the next year or two, I mean, they are north of 25% on a 2-year basis. They are meaningfully north of 30% on a 1-year basis. And, that does pose some problems because, if this second wave were not to be curtailed very quickly, and, they were to even cast their shadow on a quarter, these growth expectations will have to be pulled back meaningfully. Because let's face it, last year we got away on the earnings growth front despite growth not being great because, margins improved meaningfully. But with the kind of commodity inflation we've seen, that's unlikely to repeat itself. So I worry about earnings definitely. I think, there could be, pullbacks as far as, earnings growth expectations are concerned. And, that could lead to some kind of underperformance over the near term, which perhaps we are already seeing. I mean, if you see both the last quarter and the last month or so, India has underperformed, both in relation to EM and global markets. And, that could continue until, we reach a certain critical mass as far as vaccination are concerned. And there's more confidence on growth. And, this is also playing into sector calls. So again, if you see the last 2 months or so, what has done well is really, the global sectors, metals and mining, IT services, healthcare to a lesser extent. Whereas, your core domestic sectors, be it banking, autos, real estate, they've all underperformed. So, you would expect this construct to continue until you get more confidence on the vaccination drive, as well as in terms of growth coming back.
If you are a buyer, Bharat, a last question. If you were a buyer into India, long term as it may be, would you use the current dip to add to India, or would you wait for a bit longer tactically? And within that construct as well, would you opt for, say, while IT may be a global cyclical, but the order books are brimming and they're talking about the future with extreme confidence. So would you kind of add on to positions like those, or would you rotate towards value, domestic cyclicals, because the price destruction has been a bit more severe there?
Well, Niraj, I mean, if my time frame is, north of, basically 12 months to, 12 months plus, and, we continue underperforming for another quarter or two. One, I would definitely, if I'm neutral or underweight India, I would look to, use this phase to, beef up positions and go overweight. And, for me, the charm of India is always going to be the domestic economy. In my view, I mean, they are an economy which is going to be more driven by local factors than global factors. So yes, the local cyclicals and the local consumption-led, segments have a lot of potential. So, that's where I'd be putting my money in. IT, I think, within global cyclicals has a separate space because, it's very well geared to the kind of pickup in global capex, particularly the pickup in capex that we're talking about in the US. It's very well geared towards that. So no hurry to pair positions there.
Okay. Well, Bharat, thank you so much. This was so important to just dissect the whole global versus local piece. And I really appreciate your time and attempt to try and do that for us. Thank you so much for your time.
Thank you so much.
And viewers, thanks for tuning in to this edition of The Talking Point.